Hey there, everybody. Welcome back. Today we are going to do Chapter 17, Financial Markets. And this is going to be really interesting. We'll talk about one of my favorite things, which is awful but interesting, which was the housing crisis, the housing bubble and the financial crisis of 2007, 2008. We'll talk about how firms raise money. We'll talk about how households raise money. We'll talk about the difference between stocks and bonds and different kinds of investing in financial assets and how financial markets and financial intermediaries work. There's a lot of information and a lot of terminology in this chapter, but it's actually not that long of a chapter and there's not as much graphing. So that's what we should expect. So let's go ahead and get started. Get out your textbook. Like I said, there's a ton of terminology. I like to sometimes go through all the terms. There's a lot of terms in this one. So all the different kinds of bonds and stocks that we're talking about, things like the different levels of risk and debt, different features of bonds, so like things like equity, dividends, rates of return, and that kind of thing. And so I'm not going to go through them all, but you can see it all in your textbook. You'll see them all bolded in the slides. So yeah, let's get started. All right. Okay, let's get started on financial markets. So the basic outline of this chapter is we'll first talk about how businesses raise financial capital, and then we'll talk about how households raise financial capital. And the idea here is that businesses and households sort of represent two different sides of the market for financial capital. Borrowers who use financial capital to grow businesses, and households who supply financial capital with their savings and their investment choices. And we'll talk about that a little bit more. And then we'll talk about how to accumulate personal wealth. And this will be just a little overview of things like stocks and what we sort of should expect with respect to risk and return. So a lot of this is based on this idea of building home equity and housing markets. And the idea that housing markets are not just, houses are not just a place to live, it's also a way to make money. It's a store of wealth intergenerationally, and it's an asset against which people can borrow. And that's the kind of thing we're going to talk about today. And we see that play a role in a lot of things, including the great housing crisis of 2007. So the book talks about how in 2006, home prices were ballooning at really high rates. Homes were increasing in value. Demand was really high. We saw an expansion of home ownership. And then slowly home prices started to drop and then plummet. We saw massive rates of foreclosure. We saw financial institutions who had overinvested in various financial instruments tied to, if not explicitly based on, the housing market. And all of that led to a massive financial collapse that harmed the economy. And so that's kind of where a lot of this idea comes from. And so what we're going to talk about today is sort of how those financial markets work and what some of the many, many common terms that you might hear in financial markets are, and how these things function, how firms and households work together in that sense. And so one of the things we can think about is this idea that, first of all, we can see the effect of the recession in lots of different metrics. I like to talk about GDP, unemployment, treasury bond rate returns, rates of return. But you can see it here in the billions of dollars in corporate profits. So the idea is that everybody lost money. We tend to expect a lot of these things to go up over time. We expect GDP to go up over time, the stock market to go up over time, and corporate profits to go up over time. And what we see is a giant dip in 2008 and 2009 in response to the Great Recession and the financial crisis. And the profit trend did recover and has increased since then. But, if we fast forward to 2020, we can expect a little bit of a similar dip associated with the next great economic crisis. And so this idea that many firms don't necessarily always have enough money to invest to grow or invest in research and development. And the idea that it's borrowing and access to capital, access to borrowing and financial markets and financial resources that helps to grow our economy. And so one of the big ideas in economics is that financial markets, a well-functioning financial market, is essential for our economic growth from a lot of perspectives. So how do businesses raise financial capital? We want to think about how firms often make decisions about spending money that involves the present, but also expectations for the future and what their future profits might be. For a lot of small businesses, the original source is sort of the business owner's own money, right? You start your own business with your own revenue, maybe you get a small business loan, but as firms grow, they tend to access more capital. But there is another way. A venture capital firm is a firm that makes financial investments in new companies, relatively small companies that are just starting out, but have a lot of growth potential. And so the idea is the capital is venturing into new markets. It doesn't just apply to small startups, but they can usually and sometimes it's conditional, that the money comes with advice on products, customers, employees, strategies, and those kinds of things. And so the idea is these venture capital firms provide a lot of resources to help support new firms, especially in emerging markets, especially when there's a lot of expectation for growth. For more established firms that aren't new or just starting out, they're going to tend to use their own profits to invest in financial capital. So a big firm like Meta or Alphabet or Ford or Apple, they aren't going to need venture capital because they'll be able to raise their own finances. They'll be able to finance their own economic growth. But relatively small firms that are just starting out are going to need to access that venture capital as a source of a way to borrow and plan for the future. Did I skip one? No. Okay. So borrowing is going to tend to come from a couple of different sources. When a firm has a record of some revenues or some profits, then they're going to be able to borrow money from banks. And that's one of the main ways that firms can borrow, is they can go to a financial institution like a bank and borrow money. The other way that a firm can borrow is through a bond. And there are lots of different kinds of bonds. And all a bond is it's a debt instrument. It's a tool for debt. It's a financial contract where the borrower agrees to repay the amount that's borrowed with an added interest rate over time. And so the idea is a company can issue a bond and say, hey, we need $10,000. We're going to issue a couple of bonds. We're going to issue $10,000 bonds, and we'll pay you the total sum of the bond back plus 5% over the next 10 years or something like that. And so we see lots of different kinds of bonds. Corporate bonds will come from firms trying to borrow money. But there's lots of other kinds of bonds, and government bonds are actually pretty common. So a municipal bond is usually issued by a municipality, a city, or a local government entity. Maybe a school district can issue a municipal bond, right, to try and raise money for the school district. States can issue bonds, and that's, again, a state borrowing money, and then people will buy up those bonds as an investment strategy. And then treasury bonds are issued by the U.S. Department of Treasury, by the federal government. And bonds are very specific, right? You know exactly what kind of activity is being subsidized. There is a set amount of time when the bond will be paid off. There is a specific interest rate paid over time. And there's a specific amount paid off at the end of the day. So a bond is a very, very specific debt instrument. There's an initial borrow, there's a set time limit, a set interest rate, and a set time of repayment. And then a bond holder is just the person who owns the bond, and they'll receive those interest payments and then the face value at the end of the term. And so you can invest in bonds. And it used to be really common in like the 80s to buy savings bonds for children. During World War II, we issued a lot of bonds. The federal government sold a lot of bonds to people to raise money for the war effort. And so there's lots of different versions of this. And so it's a little bit different from the way we tend to see corporations behave. And a corporation is just a business that is owned by shareholders who have limited liability. And so shareholders mean these are people who own a share of the company or a stake in the company. So they don't own the whole company, but maybe they own 5% or 10% of the company. And then they have limited liability, which means if something goes wrong with the company, they're liable, but only to a certain extent. Like their private personal assets are not liable, but different things are. And so it's just a business owned by shareholders who have limited liability for the company's debt, but a share in its profits and losses. Corporations can be public or private, and public just means it's publicly traded. And they may or may not have publicly traded stocks. And so we see lots of different kinds of corporations present. A lot of the big firms we're familiar with tend to be corporations. And then shareholders are people who own some shares of stock in the firm. And what is a stock? Stock is just a claim of partial ownership. And so when you think about buying stock, like if you buy a single stock on Robinhood, you're buying one tiny piece of ownership of that firm. The more stocks you own, the greater your share. And then shareholders tend to own a pretty decent proportion. And then the major or majority shareholders, they're going to have the largest portions, much more significant portions. And so if you think about a company being a piece of pie, the stock is the individual portions that are divided into the shares that individuals own. So if I own, 100 stocks or 100 portions, 100 shares of the firm, that'll determine my proportion of ownership relative to what everyone else owns and relative to the amount of stock out there. And so it's really about a sort of shared ownership and diversifying or distributing the responsibility for the firm, both in terms of the profits and the losses. Okay, so when a company goes public or decides to issue stock for the first time, they will have what's known as an initial public offering. And firms do these things for a lot of different reasons. They might decide that they want to raise money for some new venture. They're trying to grow. They think they're very popular and it's a good time to make some money or really grow the value of the firm. And so what they will do is they will create an initial public offering or an IPO. And the IPO, or the initial public offering, is just the firm's first stock sale to outside investors. So, if we have a private company and it's just the three of us or the two of us, we would be the owners. We might still have limited liability. We might still be shareholders. I own a third, you own a third, another person owns a third. If we decide to go public, we're going to dilute our share and make a share available for public purchase. So maybe we go from each having a third to each having a quarter, and we take that remaining quarter and we're going to create an initial public offering to sell a certain number of shares that represent 1/4 stake of our firm. And that initial public offering is us saying, okay, there are 1,000 shares that make up this remaining portion that we're going to sell for $12 a share. And that's our initial public offering. It's going to be based on our valuation of our firm. And then investors will decide whether they want to buy or sell it. And the more they buy, it's going to bid the price up. If they don't buy it or they want to sell it, it's going to bid the price down. Investors then are going to buy those stocks and invest in that company based on the idea of some kind of rate of return, that buying the stock is going to give them money over time, right? And that's this idea, right? You invest in the stock market to make money. This is how it works. You're buying a piece of a company, and if the company is successful, then you'll either get a rate of return in terms of a dividend, which is when the firm says, wow, we had a great year. Here's a little bit of money out of our profits, or capital gain, which is the gain that you get from buying an asset and then selling it later. So in our example where we're a firm with 3 people and we reduce our shares from 1/3 to 1/4 so we can sell 1/4, if that 1/4 share of our company is sold as $1,012 stocks, and someone else buys one and then a year later sells it and makes a profit, buying it for $12, holding it for a year, selling it for $30, the additional gain, the profit they make off that sale is called capital gains. It's gains you get from buying and selling capital stock in another firm. Does that make sense? We've already gone through so much terminology. I know it's a lot. So we'll try to take it kind of slowly, and feel free to kind of back up and come forwards and then let me know what ideas are the most complicated in this chapter. When we talk about the different kinds of company, we can divide them into two basic firms types, although there's actually some variety in that and some variation within that. But basically, a private company is a firm that's owned by the people who run it on a day-to-day basis. And so that can be either a sole proprietorship, where it's a company run by an individual. So a lot of small businesses are sole proprietorships, right? It's one person, a sole person who's the proprietor or the owner. But it can also be a partnership. And so it can be a couple of people, a group or a pair of people who run the company, as opposed to just an individual. The big idea is that a private company is run and owned by the people. And so even if it's a corporation with lots of people who own smaller shares of the company, so long as they don't publicly issue stock, it's still considered a private company. What makes a company public is when the firm sells stock to the public, when they sell shares to the public, because then there's partial public ownership. And it's considered public ownership because we can't control, if like I said, we sell off a quarter of our company in shares of stock, we can't control those individuals' choice to buy and sell the stock. That's up to them. And so now public decisions are influencing our private company. Does that make sense? So these shareholders who are not owners and runners of the company own a portion of the company. So the idea that if you own stock in Southwest Airlines, you're not an owner, you're a shareholder, right? Because we don't get to make decisions about what they do, but we own a small piece. And that's the difference between being private and public. There's also corporate governance, and corporate governance is just the name that we give to institutions that are supposed to watch over executives in a firm. And so the idea that the CEO has to listen to the shareholders or something like that, it's just sort of an umbrella term that helps us understand the ways that firms and institutions can manage themselves and each other. And so you can think about, there's a little section in the book where they talk about Lehman Brothers and their corporate governance, but it's this idea that a lot of big firms have a pretty complicated ownership scheme and governance scheme, right? Who's in charge? It's usually going to have some kind of distributed power to make sure there's a little bit of people checking on each other, if that makes sense. So hopefully that gives you a sense of what we could kind of explain and understand being firms, how they work, the difference between public and private, and that kind of thing. So now we want to start to think about how households supply financial capital to the market. Because we've talked about how firms borrow, right? They'll issue shares of their company stocks to get a little money, or they might issue bonds, or they might get a loan from a bank. Those are all different ways that firms can borrow financial capital. So now we want to talk about how households supply financial capital to the financial market. And there's a couple of different ways that households do this, right? The idea is that households have excess money that they haven't spent on goods and services. So, we go and we spend some money on groceries, on utilities, on our streaming subscriptions, that kind of stuff. We buy a car, something like that. And then we have money left over. And so it could be deposited in a bank account. It could be invested in bonds or stocks. It could be invested in a money market mutual fund or a stock and bond mutual fund, or it could be used to purchase housing or other large, tangible, durable assets. Either way, these are different ways for households to store money and save and hold on to value without just consuming, or holding a bunch of cash, right? The metaphor that we always use, or the example we always use, is, a jar of cash buried in the backyard, or an envelope of cash under your mattress. And so the idea is, what do you do that's not that? And one of the big ideas when we talk about how households save is this idea of liquidity. And what liquidity means is it's just how easily one can exchange money or financial assets for a good or service. What I like to say is liquidity is how quickly can I turn it into a hot dog or a can of soda or something like that. And so if you think about, say, what do I have here? If I have a house, that's an asset, right? It's worth money. It's worth a lot of money. But if I want to turn it into a hot dog, I have to sell it. That's going to take a while. It could take weeks, could take months, could take longer. And then there's a long process through which I get my money back. If I have money in my checking account, or if I say have some money in my Venmo account, I might be able to get it out pretty quickly. It might take a day or two. And then I have cash. There we go. I can turn this into a hot dog easily. And so when we think about liquidity, we can think about things that are very liquid, like cash money, versus things that are moderately liquid, like maybe a digital account or a savings account, versus things that are not very liquid, like an asset that I would have to sell to someone else in order to get the value out of it, to turn it into money. Does that make sense? So that's what liquidity is. It's how easily can I turn something into a good or a service? How easily can I buy something with it? And so just because something has value doesn't mean I can necessarily buy something with it. A great example of this is collectibles. They're really valuable if you find the right seller, but until you do, it's just a thing, right? So if I have a signed baseball that's worth $10,000 with the right person, it's only got that value when I can actually sell it. And so liquidity is just that. How easily can I turn it into money or exchange it for a good or a service? Does that make sense, hopefully? It's going to be really important because we can always talk about these financial assets and these debt instruments in terms of their liquidity, because some have high liquidity, like your deposits in your bank account. You can usually get at them pretty quickly. What we'll find is, houses are pretty illiquid, but so are things like stocks and bonds. It can take some time. It can be a couple of days, or it could be a couple of months or even a year. And that is going to determine our liquidity, and it's going to be one of the ways we define these financial assets. So when we are defining these financial assets, the other thing we want to think about is expected rate of return, risk, and actual rate of return. And this is the idea of what is this asset going to do in the long run. And so I'm going to have an expected rate of return, how much I expect to get back to me if I invest in a project. It's either going to be based on a future interest rate or future payments, increased profitability, or capital gains. So, for example, if I want to invest in Apple, I might say, yeah, I expect a pretty high rate of return. I think the company's going to do well, or I think I'll be able to sell the stock for a lot of money. If my cousin wants to borrow money to start a llama farm, maybe my rate of return is different. It's going to be based on how profitable I think that business is going to be, or what payments my cousin promises to make to me. And so expected rate of return is just sort of what you expect to get out of an investment. The actual rate of return is what actually happens. So relative to what I put in, what did I actually get back? And in between these two is this idea of risk. And risk is both how much projected profitability there is, but also how much uncertainty there is around it. And when we think about risk, we want to think about two main types of risk. Default risk is the risk that the borrower just doesn't pay the thing back, so they default on it. So, for example, if I invest in my cousin's llama farm and she calls me up a year later and says, you know what, I know I promised to pay you back, but I can't. I'm broke and I'm moving to Alaska. That would be default. She no longer plans to ever pay me back, and I might be in trouble. Interest rate risk is a little more complicated. Interest rate risk, well, real quick, default risk. Here's the way you've heard default risk probably. You've heard the phrase default on a loan or default on debt. Countries that issue bonds can default on their debt. When we think about like the city of Stockton becoming bankrupt, they defaulted on their debt. They just said, listen, we can't pay these bonds back. When we think about the housing crisis, people defaulted on their mortgage debt. And so the bank said, okay, well then I'm taking the house back. You didn't fulfill your obligation. And so default risk that's where you've probably heard it. You can default on your student loans when you stop making payments, that kind of thing. Interest rate risk is a little bit more nuanced. And it's the idea that as interest rates go up, we might see, or as inflation goes up, we might see real interest rates fall. And so the idea is if I'm paying back 5% every month, then the bank expects that to have a certain purchasing power over time. But if inflation is going up to, say, 10%, then maybe that's going to decrease the purchasing power of that 5% that I'm paying back to the bank. And so interest rate risk is just this idea that interest rates may fluctuate either in variable or in nominal terms, but usually in real terms. And so the return I'm getting on this loan is going to fluctuate. And so that's something that we'll talk about a little bit more later, and I'm happy to explain more to you as we go on. It's a little bit more nuanced. So those are different things you want to think about when you're borrowing and lending, is not just the liquidity of the debt instrument or the bond or the stock or whatever, but the risk associated with it, the expected rate of return, and then eventually look back and say, oh, wow, this is the actual rate of return that I got. And that's going to be really important for households. And when we think about this idea of all these different dimensions, rate of return, risk, and liquidity, we realize there's a lot of information associated with financial markets. And so in a lot of cases, it makes sense to engage with a financial intermediary. And a financial intermediary is just an institution that receives money from savers and provides money to borrowers. So if you think about a bank or a investing company, those are lots of examples of financial intermediaries. Generally in financial capital markets, we think about banks being the financial intermediary, because think about what happens at a bank. What does a bank do? A bank has savings accounts, checking accounts, those kinds of things. Those are places where people put money and save them. But that's not where banks make their money. Banks make their money from the other half of it, where they issue loans, mortgages to buy houses, small business loans, maybe student loans. Where does the money for those loans come from? It comes from the savers. So they collect the money from the savers, then they do some research about a borrower and issue loans to borrowers. The borrowers pay the money back. The savers get their money back with a little rate of return. That's a financial intermediary. Financial intermediaries are these institutions that connect borrowers and savers and lower the information costs. So if you think about the difference between a savings account or the example of my cousin's llama farm, what sounds riskier? Probably the llama farm. And the idea is when I put my money in a savings account, the bank does the work of determining which loans are risky and which aren't, what the rate of return might be, what the expected rate of return might be, and making the choice about where to invest money so that I don't have to. So that's really what it is. It's about lowering transactions costs, the costs of getting together, and lowering information costs. And there's a great example of this here. This is from the textbook too, but this illustration shows how we have borrowers taking loans out from banks and paying the loan back with interest. And we have savers depositing money into banks and then withdrawing their money and getting interest payments. And the banks are just this intermediary, right? It's like a middleman, right? They're in the middle between savers and borrowers, connecting them and sort of judging them both and doing all the middle ground work, doing all the information work, doing all the contracts and that kind of thing, making sure everything is safe. So Banks are a financial intermediary. They're in the middle of borrowers and savers. Does that make sense? I like this. I like this picture a lot because I think it does a really good job of explaining it. And banks do this a lot of different ways. And you know that because I bet if you talk to a bunch of different people, you'll find a lot of different ways that people access financial intermediaries. One really common way that banks collect resources is through a checking account. And checking accounts are pretty common, right? It facilitates easy transactions because it gives you access to money. It used to be by writing a paper check, but now more commonly it's using a debit card. They don't tend to pay any interest, but it's very liquid, right? You put your money in, you get direct deposit or something like that. And it's very easy to pull money out using your debit card or making a financial transaction. And a debit card is just a card that works like a credit card, but instead of owing a credit company or a creditor, it is pulling money directly from your checking account rather than being billed with interest. Does that make sense? This should be pretty familiar, hopefully. If you have questions about your debit card, let me know. But it's basically just a card that functions like a check, and it allows you to pull money electronically from your checking account. A savings account, on the other hand, is a little bit less common, but still pretty useful. And savings accounts tend to pay some interest rate, although the interest rates are usually pretty low. And the idea is you hold money there, but it's a little bit less liquid. If you want to pull money out, you usually have to go to the bank or an ATM machine or maybe make a transfer, but you don't usually have a debit card associated with it, so it's a little bit harder to pull money from. And the idea here is that when we talk about all these different things, what we're going to see is you kind of get paid for the lack of liquidity. So checking account has the lowest liquidity and no interest. Savings account, a little bit less liquidity, but a little bit more interest. A certified deposit has even less liquidity, but a higher rate of interest. And the idea there is you say, I'm going to deposit this in the bank for a set amount of time, 6 months, 9 months, a year, 5 years, and the saver commits to leaving that money in that CD, in that deposit, for that period of time. And in exchange for that loss of liquidity, the bank pays a much higher rate of interest. And the idea there is that the bank knows you're not going to come in and take the money, and so they can go ahead and loan it out and do different things with it while they have it to grow it. And then they don't mind paying you a little bit more for it. And so it is this idea that people are compensated for two things in finance. They're going to be compensated for lack of liquidity and for risk. Make sense so far? Hopefully. Okay. One of the things that's tricky about this is that interest rates fluctuate a lot over time. So here we have interest rates for 3 different debt instruments. We have a 6-month CD in the purple line, the lowest return because it's the shortest period. We have the teal line is the 1-year CD, and then the dark blue line is the 5-year CD. And what we can see is, first of all, lots of fluctuation over time. Generally, though, falling, especially when interest rates have been low, and in response to the business cycle. We tend to see interest rates be really high at certain times and really, really low when the economy is really strong. We've seen a pretty steep decline since the Great Recession as banks have been less inclined to compensate consumers for their deposits. So what are banks there for? Bank accounts are great. If you're an investor, it's going to give you an easy resource to access your money. It's going to be very safe. Bank accounts are insured by the FDC or the Federal Deposit Insurance Corporation, and it protects your savings and checking accounts up to $250,000. Banks are going to tend to have low risk, low rate of return, and high liquidity. And so that's one way that households can store their money. And so there's a lot of advantages. It's really common, but it doesn't give you a lot in terms of a rate of return, expected or actual. And so if we want to think about another higher rate of return asset, we can talk about bonds. And we talked about this at the beginning. There's lots of different kinds of bonds. The risk associated with bonds depends on the borrower and the activity they're engaging in. The U.S. government treasury bonds are going to be very safe. State bonds are going to be a little bit less safe. Municipal bonds a little bit less safe. And then there might be what's called high yield or junk bonds. They're going to have a really high interest rate, but there's a high probability of default. So it's a very high risk asset. But that's the way that relationship tends to go. High risk, high return. Low risk, low return. So treasury bonds, low risk, low return. High yield or junk bonds, high risk, high return. And a bond is basically an IOU. It is basically saying, hey, I need to borrow some money. Hey, I'll lend you some money. And it has three main components. It's going to have a face value, which is the amount that the bond issuer, the borrower, agrees to pay. So if I am trying to borrow money for the city of Sacramento, I'm going to issue bonds with a face value of $5,000 each. There's going to be a coupon rate or an interest rate, and that's the regular payment, the interest rate I'll pay you. So $5 a month, $100 a quarter, something like that. And then there's a maturity date, the due date when that bond is paid in full. So if I issue bonds with a $5,000 face value and a $20 a month coupon rate, I'll pay those $20 a month payments up until the maturity date when I pay you back the full $5,000. As well as whatever the remaining interest rate is, maybe that extra coupon rate or whatever it is. And so that's how a bond works. And they tend to be relatively safe, although it depends on the type of bond. But when we combine a bond's face value, interest rate, and maturity rate with market interest rates, a buyer can compute the present value of a bond over time. So basically saying, okay, given that I'm going to loan this money out, I'm going to get this stream of payments and this final payment, how much is all of that worth today so that I can determine whether it's a good investment? The bond yield is what the expected rate of return for the bond is at the time of purchase. So what I expect it to be worth over time. Overall, bonds are a pretty decent investment. They tend to be pretty moderate risk depending on which ones you invest in, and low to moderate levels of return or rates of return, and moderate liquidity. The liquidity is going to depend on the bond type too, because it depends on the secondary market for the bond and the maturity date of the bond. So you can get a 5-year bond, a 10-year bond, or you can get a bond for which there's a secondary market where you could sell it if you wanted to. And so it's like a nice next step in terms of risk, return, and liquidity relative to a checking account. And we can look here at bond interest yields over time. And here we have the corporate bonds coming from firms and U.S. Treasury bonds. And you can see corporate bonds have a little bit higher rate of return. It tends to fluctuate with the U.S. Treasury bond, but that makes sense that they're going to have a higher rate of return because a corporate bond is riskier than the U.S. government, which is more likely to default on their debt. The United States of America or literally any company. That's going to give you a sense of the risk and the return associated with it. So these interest rates can show us a little bit about the market conditions over time. Corporate bonds will always pay a higher interest rate to make up for the higher risk of default. Next, we're going to talk about stocks. If you've been waiting the entire semester for this econ class to talk about the stock market, we're finally here and we're doing it. So stocks are another investment tool, another financial instrument, and it's basically a share of a company. And the rate of return for a stock comes from, like we said, two different forms. It can be dividends paid by the firm, so the firm makes good money and says, hey, take some. Here is a couple of dollars per share per period, per quarter or per year or something like that. Stocks can also give you a return through capital gains. Buy low, sell high, make money. That's capital gains. It's the profit you get when you sell a stock for more than you paid for it. And you can imagine capital losses too. I bought GameStop stock and it was $100 a share. And then I sold it for $20 a share and I got negative capital gains. So that kind of idea. There are a lot of different ways to measure the performance of the stock market overall, but a lot of the ways we measure the stock market and the health of the stock market sort of in general is through an index that looks at a bunch of stock prices together. And this is the kind of thing you hear a lot when you hear the news talking about the Dow Jones Industrial Average, Standards and Poor's, or any of these stock market indexes or indices that will tell us a little bit about what we expect. The NASDAQ, the Nikkei, those are all other ways of aggregating stocks and measuring the success and the health of the stock market. And so the idea is they have some initial period, and we'll look at a graph of the S&P 500 right here, where we consider it a baseline, and then we compare the prices of the Dow Jones Industrial Average, of the S&P 500, of any of these stock market indices, and we watch the prices fluctuate over time to see how the stock market has grown. And we see a lot of up and down, but if you zoom in, there's, even with all these massive variations we have day to day, the overall trend is growth, especially if you look at the post-Great Recession area. We see a lot of very strong, healthy growth in the economy. And so the stock market has definitely increased dramatically in value over time. And it's really fun. You can go into any search engine and ask for the stock price of, or a stock index price, and look at it over time, over a year, 5 years, a month, and you can see the fluctuation you see day to day, but the overall trend tends to be upwards. And there's a table in the book, in table 17.1, that looks at different stock market measures and talks about how they're generated. So for example, the S&P 500 is based on the 500 large firms in the United States, that was chosen by analysts at Standard and Poor's, and this is a very old method. NASDAQ was formed in 1971 as an electronic stock market that allows people to buy and sell from different locations. When we think about the Dow Jones Industrial Average, that's based on 30 large companies. There's actually a couple of different versions of the Dow Jones now based on the size, the capitalization of the firm. But check it out. If you go do a couple of quick searches, you can see a lot of interesting data there online. What's the bottom line for stocks? Stocks are going to have a higher rate of risk, but they're going to also have a higher rate of return over time. The short run risk is much higher relative to the long run risk. And you can always, and we'll talk about this a little bit more, you can always manage your risk through diversification. The other thing is that the liquidity is relatively high, right? So stocks are pretty easily bought and sold, especially in the modern era where we have apps on our phone that allow us to buy and sell stocks. That really increases the liquidity, especially when compared to things like bonds that have a set date to maturity. The liquidity on stocks is really flexible because you can always find someone to buy a stock, but it's going to depend on what return you expect. So high risk, high return, high liquidity. Cool? All right. What about mutual funds? A mutual fund does the thing I was just saying. It helps you diversify. Diversification is buying a wide range of stocks and bonds to help reduce the level of risk. Basically cancel out extreme high risk with some really low risk and have a lot of options. It's the opposite of having all your eggs in one basket, if you know that idiom. It's the idea of saying, well, I'm going to invest in a little bit of everything. I'm going to invest in cars and boats and trains, but I'm also going to invest in produce and computers and video games. And that way, if one of those is successful, then so am I. A mutual fund basically is an organization that buys a range of stocks and bonds from different companies and sort of picks them for you to balance the risk and the reward for you. And so you pay them some money and you say, hey, yes, I'd like to invest in a mutual fund based on a certain rate of return over a certain period of time. And they say, okay, bye. Here's this bundle, this basket of 10 stocks and 5 bonds that will get you pretty close, we think, to those goals. An indexed fund is very similar. It basically just uses one of those stock indices, those stock indexes that we just talked about, like the S&P 500, but it doesn't need to be professionally managed by a person, and so it tends to have lower fees. And it's basically just going to mimic the market's overall performance. So it's going to help diversify against the firm level risk, but you're still going to be subject to some market risk. Mutual funds tend to have high rates of return and high levels of risk with high rates of liquidity. And the risks and returns for an individual mutual fund are going to be lower than that for the individual stock because of that diversification. It doesn't say this here, but the reality is indexed funds also have a good rate of return, really manageable risk, and they're going to tend to cost less than mutual funds because they're not professionally managed. So you don't have to pay somebody to manage them. The index is already managing it. What other ways can households save or invest or grow value? Well, this gets back to what we were talking about, my little cartoon here. Housing and other tangible assets allow an owner to build equity. And equity is just the monetary value that the owner would have after selling a house and repaying the outstanding loans. So if this is my house and it's worth $400,000, but I took out a mortgage and I still owe the bank $250,000, then my equity is the value of the house minus my loan, or $150,000. It's what I could get if I pulled money out of the house. Investment in a house is very different from bank accounts, stocks, and bonds because there are both financial and non-financial returns. It's tangible. It's a real thing I can touch. So it has some intrinsic value as opposed to a stock, which is really, truly just a fancy piece of paper that can fall to zero value. Part of the return on investing in your home is that you get to consume housing, right? You invest in a home, and not everybody lives in homes that they own, but most people who own a home live in a home that they own. And there is the possibility for capital gains, especially in markets like California and markets like we've seen where home prices are on the rise. There is the possibility that you not only hold equity in your home, but that after living in your home and extracting value from living in it, you can also make money off of selling it. And so that's a really unique situation that you don't see with stocks, bonds, and checking accounts. And if we look at the median average sale price for single-family homes from 1990 to 2015, we can see they've tended to go up by a lot. Here you've got the housing bubble, right, where you can see home prices accelerated very quickly in the early 2000s and then dropped precipitously in 2006, 2007, 2008, but they've since truly recovered and are much higher than they were in 2010 and 2006, and even they're higher now than they were in 2015. This average is going to look a little crazy if you're living in California because these are the national average. And so we're going to tend to see the California housing market be a little bit more expensive in general, and also homes be worth more now than they were in 2015. But that gives us something else to look at and something else to compare to and a sense of the growth in value of those assets. And so, if we're talking about capital gains, if you buy a house here and sell it here, you might take losses, but buy a house here, sell it here, or even buy a house here and sell it here. Say buy a house in 2011 and sell it in 2015. You can see how those capital gains will come out, right? You'll make money because the house is worth more over time. So, what other tangible assets are there? You can also invest in commodities. You can invest in precious metals. The returns on these investments are going to depend on a couple of things. It's going to depend on the market, the ability to buy low and sell high, and capital gains that you might receive at the time. You can also invest in collectibles, right? art, wine, jewelry, antiques, sports memorabilia, other collectibles. Those are going to have pretty nice returns so long as they remain rare and valued by other individuals. And in a lot of these tangible assets, the rate of the return it's going to depend on how thick the market is for buyers. The risk is going to depend on a lot of different things. It's going to depend on the asset, and it's going to depend on the sort of supply of the good. The more rare something gets, the greater the value usually, so long as someone else thinks it's valuable too. And then the liquidity is going to tend to be low because you have to find the right buyer, and it usually takes some time. So we talked about the liquidity of housing. Think about if you had, I think we talked about if you had a rare baseball, signed baseball or something, you'd have to find someone willing to pay. And there are things that reduce the sort of costs of liquidity, things like eBay and other websites that connect buyers with sellers. That's going to increase the liquidity, lower the information costs, and make it a little easier. So, and just before we jump into this chapter or into this next section, when we talk about this idea of how to accumulate personal wealth, if you want to check out, there's a great summary table on page 417, table 17.3, compares the risk, return, and liquidity of all of the different assets we've talked about so far. And that's a great little resource if you want to summarize what we've talked about so far in the chapter. So, last section, how do you accumulate personal wealth? A lot of people, when I find they're going to take an econ class, they're kind of hoping that they're going to find out how to get rich. And that's not entirely what economics talks about, but we'll talk about it a little bit here. The fundamental problem with accumulating wealth in the stock market and other high-risk arenas is that it's hard to predict the future. And future news is going to have an effect on returns, capital gains, interest, dividends, and other profits. Because stock prices shift in response to unpredictable things that happen in the future, prices are going to tend to follow what mathematicians call a random walk with trend. The trend basically means that over time, we're going to see it trend up. But the random walk means that the journey there is going to fluctuate up and down a lot. And so there's not really a way to account for that randomness besides holding on for the trend upward. The majority of financial investors cannot outguess the markets. There are studies where economists will try to pick stocks and then compare them to randomly picked stocks by throwing darts at a newspaper, and the random tends to beat out the really well-educated and well-informed economist. So instead, you want to trying to pick stocks that are going to have some huge gain as a way to get rich is going to tend to be pretty low probability. It's equivalent to hoping for a winning lottery ticket. And if you don't believe me, go back and check the stock market real quick. And here, I'll show you. Okay, so here is a well-known company, Apple. And here's Apple's stock price today, starting at 6:30 a.m. when the market opens on the East Coast to now. Not a lot of fluctuation. So if you're going to try and make money, this isn't the way to do it. Now let's do the 5-day picture. So the 5-day picture says, wow, here we are at a stock price of $169, up to $169, down to $165, up to $73. Not a ton of variability, but a little bit of a drop from the 4th to the 5th. I'm not sure what was going on Thursday and Friday. Now let's look at the month variability. Now we see, okay, here's some variation in price. Still not a huge variation in price, but we see growth from $160 to $173. Now let's look at the year. The year has, again, this randomness, up and down, but with a trend. The trend is upward, right? So even though we went down and then up and then down and then up, that randomness is accompanied by that trend. Now let's look at 5 years. Again, lots of ups and downs, but an overall trend up from 2013 when the price was $47. If we take it all the way out to the longest stretch we have, going back to 2006, Apple stock was $3.02. But the trend up has been to $169.59 with a high of $179 and a low of $2.79. When do those prices hit? Well, it's random, but it depends on the previous period. So it's a random walk with an upward trend. Hopefully that makes sense. So the big takeaway here is that very few people get rich over holding stock for a short amount of time. The real way to make money and accumulate personal wealth is slow and boring, which is actually the title of the section, Get Rich the Slow and Boring Way. And there's two really big ways. The first is to invest in yourself, in your own human capital, in education, training, and other things that help you earn higher wages, higher income, and give you access to more money. And then to turn around and start saving early in life. And what we mean by saving is investing in those low risk, low return assets with compound interest. Compound interest is amazing. It's going to help you grow your wealth over time through adding interest to the principal over time. So simple interest says, if I put $100 in the bank, I'm going to get 10% interest on it, which means I'll get $10 every month for the rest of the time that money's in the bank. Compound interest says, hey, first you're going to get $10, but then the next period, when we multiply that by that 10%, you're going to get 10% on $110, meaning you're going to get an extra $11. And then when you multiply that by 10%, now you're going to get an additional $12.1, giving you 133. And so compound interest is a great way to grow money if you have time. So that's why people will tell you, invest in your retirement early, put money away early, because these low risk ways of investing are really the great way to grow wealth. And this brings us back to the financial crisis and what happened in the Great Recession. When the housing bubble burst, banks felt really risk averse. They were afraid to make loans. And loans are essential. They're essential for households to grow wealth, essential for households to borrow money to build housing, start new small businesses, and borrow for education and other big purchases. And the financial market is essential for firms to borrow, to build, to expand, and to engage in research and development. And so when we have a large economic crisis like the financial crisis, where we see our financial markets collapse, that really hurts our economy because it slows down and limits our ability to grow wealth and to invest in our future through different capital markets. And so it's really important to keep our financial markets functioning well in order for the health of our economy. So that's it. That's the chapter. If you want a little more information on how compound interest works, there's an example in the book right here, that goes through how $100 with $5 per year can grow, and the formula for compound interest, which is a function of the interest rate and the length of the investment. But that's it. So let me know what questions you have, and I'll see you next time.